Hello, friends. I'll be talking a bit on this stock selection strategy, building profitable portfolio. So, this we did it as part of our JIX 2024 meet on 18th October. So, the disclaimer is I'm not an expert in stocks. So obviously, I'm a doctor. So, this is for stock naive intensive care friends who may wish to understand certain basic things that one needs to know about how you go about choosing stocks and what are the key things that one need to have in mind. So when we talk about a topic like this, I would have attended 6 months courses on and multiple 3 months courses, so on and so forth. So it's impossible to get the whole essence in 10 minutes or 15 minutes talk. But I'll just give you a brief overview as to how you go about in trying to identify the stocks that you may want to invest in. So stocks or equity, they're all the same. So when you look at the equity, so there are some perspectives that is from my own experience of trading from last 20 years. And many of it has been taken from some of the courses that I may have attended. So when you talk about equity, I tell all our good friends and my trainees that we need to have four broad categories. So the one major category is mutual funds. So obviously my talk is on stocks, so someone else would have covered on mutual funds. So every doctor or every intensive care specialist should have their money put into mutual funds. So that goes without saying. And when you put money into mutual funds, you should forget for 15 years. So your money has to be parked there for at least 15 years because there is a compounding that happens and that gives you a lot of benefit. So my suggestion for all doctors is they should have some money of savings parked in the mutual fund. So obviously I won't be talking, someone else would have covered that. So then you have long-term stocks. So I want all our doctors, the focus of my talk will be on these long-term stocks and all our intensive care friends should put some savings into long-term stocks. And when you put here, your thought in your mind is that that money is there for 7 years. So you need to block that money for 7 years because you don't get the huge returns if you keep it for a short time. So there are certain stocks which are meant to be there for 7 years, at least minimum 7 years. You can keep it longer also. So my focus of this talk is on this particular area as to how you choose stocks which you would keep it for a long term for 7 years and reap the dividends. Then there are the short-term stocks. So my perspective of short-term stocks is where I invest and try to exit within 1 year. So the minimum, the sort of timelines that we look is 3 months to 1 year. I try to exit with some defined percentage profit. So it could be 10%, it could be 15%, whatever you determine. So you exit within that frame, that period of time. So if your target is hit at end of 3 months, you can exit, take the money, and so that you have made some money. So short-term stocks, I won't be talking of short-term stocks for because short-term there are variables that tell you as to there are different scores. Like there is a Petrosky score, there's an Altman Z score, modified C score. So like Apache score, like SOFA score, we have scores in stock market. So we look into these scores and say, okay, I invest in this, anticipating that the stock will go up by 12% or 15%, and then I reap the dividends. So this particular talk, I won't be talking on short-term stocks. I do all this. I do mutual funds, I do long-term stocks, I do short-term stocks, then I do trading. So futures and options. So this is not for today because futures and options is very high risk. So here you generally the expiry dates for all futures and options will be at the end of the month. So the last Thursday of every month, you have to exit the trade that you would have taken. So this is very high risk. But for a advanced intensivist, like if it's a first year intensive care trainee, I say you have to have in mutual funds and long-term stocks. And once they advance, like I'm trying to draw an analogy with intensive care. Once you're in a final year DRNB, DM, or you're an associate consultant, then you start playing short-term stocks. But if you want to play F&O, you need to have a lot of experience and then you should have a huge risk appetite. But for any intensivist, you deal with a high risk sort of a situation. So I would expect all of you should have some knowledge on all these four dimensions. But today's focus is only on long-term stocks because that is the safest one. Even if today you ask me, my bet would be on long-term stocks because you make more money there, more safer, more peace of mind. I do more on F&O, then I'm agitated and peace of mind is less. Short-term stocks is also okay, but sometimes that can also give you grief. So when we talk about long-term stocks, we have to look at sectors. So for all our friends here who are listening, so you should stick to around 8 to 10 sectors. So like I will tell my own portfolio to you as to which are all the safe bets. So this is an auto industry. So this is a two-wheeler industry, or so like Bajaj Auto is a one sector where you can put. So there are different sectors in that. So all two-wheeler sort of a industries. So it could be Honda, it could be Bajaj Auto, or it could be anything like that. So that is one sector you should keep in mind. Then you have a pharma sector. Like for me, the investment for 7 years, I would put in Divis Lab. So you can think there are so many other sectors. It could be Glenmark, or it could be Procter and Gamble, so on and so forth. So it can be Reddy's Lab, so on. So pharma is one sector. Since we are doctors, we should have one portfolio into pharma. Then you have banking. Like my portfolio of long term, I have in HDFC Bank. So you could have in HDFC, or you could have in Axis, or you could have uh, 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 that's not, it can be RBL. So one of the banking. So so banking is one sector which you should keep in mind. Then you have FMCG, which is fast moving consumable goods. So fast moving consumer goods are like your toothpaste, soap, so on and so forth. So like my long term in FMCG is Godrej Consumer. So it could be anything. It could be Nestle, or so on and so forth, or it could be Procter and Gamble, or it could be Marico. So all those are FMCG. So as I said, my portfolio, I have Godrej Consumer. So then you have IT. So IT industry, you have TCS, you have Infosys, you have Mindtree. So like my portfolio, I have Infosys. And so what I'm only trying to say is you can't put, if you have say 1,000 rupees, you can't go and say I'll put all 1,000 rupees into pharma. You have to split it into 7 to 10 sectors. So this is called sectoral investment, and every investment should think sectorally. You can't say I'll put all eggs into banking, because the prices of these sectors keep fluctuating at different timelines. And then there is infra projects, like I have my long term in Larsen and Turbo. So you could have it in any infra. So Larsen and Turbo is the more commoner ones, more stable. So you could think of infra. Then you have four-wheeler sector. So here I have my long term in Maruti, because these are all stable ones and which are all time tested. So four-wheeler industry is one thing that you can think of, or Tata Motors, so on and so forth. And then the last one is oil industry. So it could be oil like Reliance, or it could be power. So as you see in this, in my portfolio, I've shown 7 sectors. You can go up to 10. So in 10, you may have, see here I put oil. So there can be fertilizers industry. And I have not put metals in this. So there is Tata Steel. So you can put metals also. So, but not to exceed 10 sectors. 7 to 10 sectors will encompass pretty much all the dimensions of, different industries that are prevailing. And all these sectors, when you put it in a, I'll talk about how you choose the stable ones. When you put for 7 years, like I tell you in my portfolio, I put in all these. Most of them would have, some of them have doubled, like, Larsen and Turbo has doubled. But all of them will be in profits. They'll all be in 30%, 40%, 50%. They'll all be in profits like that. So that is the beauty of putting them in long-term stocks, so that there is a compounding effect, and there will be a gradual increase in the dividends. So optimum is 7 to 10 sectors. So it is desirable when you're investing. If you have 10,000 rupees, you put 1,000 in each of them, so that your 10,000 is done. If you have 20,000, you can again multiply. You buy, rather than buying one stock, you buy 2 stocks in each of these. So 7 to 10 sectors, you can keep it. But if you want to double it, suppose you say I want to have 20 in my portfolio, then you have to do two different ones in each sector. Like if you have Divis Lab, then you have some other Lupin or something else. But you have to stick to that pattern. So you should not deviate from that pattern. So now the question is, now I've just sporadically told you the names of certain industries, but how would you choose and how would you analyze? So when you have to analyze the stocks, there are two broad categories. So you have fundamental analysis, then you have technical analysis. So when you are thinking of long-term investment, generally you pay attention more to fundamental analysis. So it is about predicting the outcome in a patient. So obviously we look at clinical examination, we look at lab parameters, then we look at monitored variables, so on and so forth. In stocks also you have fundamental and technical analysis. For fundamental analysis, you should have some understanding of seeing the balance sheet. Then you have to look at the profit and loss of that particular company. Then you look at PE ratio. P is price and earning ratio. So price of the stock and the earnings that it is giving. See, this is very important. P ratio is something. So we look at various ratios. Then there is something called PEG ratio, which is price earning growth ratio. I'll just talk to you very briefly about this. And this is price divided by cash flow. So these are all some of the ratios which one has to at least have in mind what they mean. And there are defined criteria as to what this number should be. Then this is price to book ratio. So these are some of the common nomenclatures that are used in fundamental analysis. And then you look at the market cap. So market cap also is important, but all the long-term stocks, you need to have a large market cap. So large market cap gives you the stability for that company. So these are some of the simple nomenclatures that one you need to look at fundamental analysis. Then what is technical analysis? Technical analysis is when I'm doing short-term trade or when I'm doing futures and options, F&O trading, then I need to have some knowledge on technical analysis. Technical analysis, we look at charts. So like you see the graphs in ICU, you look at like you see temperature chart, blood pressure chart, we look at the graphs like this. So these are all called charts. This is the candlestick chart. So in this, just roughly, because since you may be new to all this nomenclature, so we call it as a, you might have heard bullish and bearish. Okay. So the green ones are the bullish candle. Means if you see the bullish candle, they are taking the curve up. You can see it is taking the price of the stock up. And the red ones are bearish. They take the stock down. If you see one red one, you'll see the curve starts moving down. So these are all called bullish and bearish candles. And then when you look at the charts, you look at the resistance and support. So the line below is called the support levels, and this is the resistance level. So this is the support and this is the resistance. And then we look at the timelines. At what timelines this change in the curve is happening. So if you go to any of the apps that you would look into how the stock is behaving, if you can see carefully here, you have 1 day, 5 days, 1 month, 3 months. So you have to look at the timelines. Like in ICU, you say 30-day, 90-day outcome. Here also you have to see how the stock is performing over last 1 week, or last 1 month, or last 6 months, or last 1 year, to have some semblance as to how the stock is behaving. And then you need to look at the volumes. Volumes is how much people are trading in this. So that gives you some inkling about how much demand is there for that stock, or how much less demand is there for the stock. So the key things to keep in charts is you look at the charts, you look at the trends, bearish, bullish, you look at the support level, you look at the resistance level, you look at the volumes, then you look at the timelines. Along with that, there is something called oscillators. Oscillators or indicators. So I won't go into details. So there is this divergences or RSI index. So these are moving averages. MA is moving averages. MACD, these are all the standard nomenclature. MACD is moving average, convergence, divergence. I'm sure most intensivists know what divergence is convergence. So if you see here, there is a bit of a divergence because here you have a candlestick which is going down, but you have an RSI going up. So this is a divergence. That's why we say bullish RSI divergence and RSI index. So these are called oscillators or indicators, which tell you, which gives you a little predictability as to how your stocks may behave. So I think that's about broadly fundamentals and technical. So you may need to undergo rigorous sort of a training for at least some 3 months course to understand how you interpret these technical nuances, but that is not the scope of today's talk. So today's talk will look into what do you understand by financial statements and balance sheets. So what do you understand by balance sheet? So in balance sheet, so basically we look at assets that the company has and the liability. What is the company's liability and what is the owner's equity you have? And the strength of the balance sheet is basically looking at the ratio of the debt. So this is the debt. Debt. What is the debt that the company has and what is the company has invested? That ratio we look. What does the company own and what is the borrowings that the company is made shows the strength of the balance sheet. So the lower the debt, so better is the balance sheet for that company. And then obviously you have to look at the profit and loss statement. So profit and loss, basically you look at the revenues minus the expenses. So obviously, what is your earning and what is the expenses, and that gives you operational profit. So the revenues minus this would give you operational profit. And this operational profit, so when you talk about revenues, revenues is dependent on the sales and other incomes. And operational profit minus tax will give you the net profit. So this is the, in rough sense, the profit and loss statement that you would look at. So then what is the PE ratio? I spoke about the PE ratio. PE ratio is market value of the share. So the share may be trading at around 800, and that at that value, what is it earning? So market value of the share divided by earning per share is the PE ratio. If the PE ratio is 20, if it is, then it means the stock is overvalued. Then your thought in your mind is that it continues to grow. It's already inflated. It's already overpriced, and then you are expecting it to grow beyond that. So P ratio gives you that little sort of a semblance or inkling as to what is happening to your stock. If P is low, then it means it's undervalued, and it undervalued can be due to various reasons. But all this has to be taken into the context. It cannot be taken at just a face value and interpreted. But it just gives you a sense that it is overvalued or undervalued. So if P is high, then it means it's already inflated, and you're expecting it to grow further from there. And low PE means it may mean the company is not doing well, or it may mean that it is undervalued. You can buy and make profit. So the better representation is PEG ratio. PEG ratio is PE ratio divided by annual earning per share growth rate. It's a growth rate. PEG. So they say the PEG is better indices than the PE ratio, and the lower PEG, the share is undervalued. So it is like PE, but it is a much more robust indicator. Basically, it shows you the growth rate. It's the estimated growth rate, because PE ratio does not tell you how the growth is going to be. PE growth rate, PEG is price per earning growth rate. It sort of shows you prediction of possible growth. So just to give you an example, you are taking two companies. There is a network company, the Airtel or one of them. The PE ratio is 50. What it tells you is that it is overvalued stock. But then you are looking at annual earning per share growth rate is 20, means it is growing at a higher level. But the PEG ratio, if you look, which is PE divided by annual earning per share, PEG becomes 2.5. So it is not a great stock to buy, because it is sitting at an already inflated price, and it is showing higher growth, but the PEG ratio is also higher. PEG ratio should be lower for us to buy the stock. But when you look at the beer stock, whatever beer stock, PE ratio is little lesser than the network sort of a PE ratio, but the growth rate is less. But if you see the PEG is lower than the network company, so this is a better stock to be buying, because it is undervalued. This is overvalued, the network one. So this is the way we interpret these ratios. So hopefully you got some sense of what it means. So what we are trying to say is PEG is a better ratio than the PE ratio. If your PEG is lower, then maybe it is a better stock to buy rather than looking at a higher PEG. But if you look at isolated PE here, and if you look at the growth rate, they seem to be contradictory here. But ultimately, the PEG rate is a better reflection of possible growth, is what you can decipher. Then there is something called GARP. GARP is growth at reasonable price stocks. So which tells you that stocks have a good predictability of growth, and they are reasonably priced, which means they have a good growth rate and they're priced at a lower price. So PEG less than 1, like SMR less than 1 is a good thing. So PEG less than 1 is a better thing. PE ratio less than 15 tells you that stock is reasonably priced and they have a better growth rates. And you have to look at the growth and the growth of the company. If it is 20% revenues, it is yielding for 5 years, or 20% profits it's making 12 months year on year, or 12 or 20% in 3 months year on year. These tell you that growth is happening in a very significant way. So just Peter Lynch is one of the very popular technical analysts who said, go for a business that any idiot can run, because sooner or later any idiot probably is going to run it. So which basically tells you don't have to put too much mind. So basically you have to interpret these ratios and just act upon it, because if you go digging into all the other details, not necessarily it may show you the right path. So sticking to certain ratios will at least give you a semblance how the company may be. So simplistically, you can say PEG ratios have to be low, PEs have to be low, and the growth rates have to be substantial at around 20% in last 5 years. Then you can pick up that stock. So now coming to blue chip stocks, the first sectoral company names that I suggested, they're all blue chip stocks. Blue chip stocks is safest stocks which are not disturbed by any of the market forces or any geopolitical issue. Here, the funding, the capital investment will be more than 4,150 CR, and the annual growth rate, as I showed you in the last slide, will be more than 20% for 5 years. And debt per equity ratio, which I said there should be less debt. So it should be less than 2. So there should be less debt. So all blue chip companies will have debt per equity ratio less than 2. And return on equity should be more than 20%. And there should not be dip in more than 20% in any year. So it should not be less than 20%. There should not be more than 20% drop in any year. So all these are some of the criteria to determine which are the blue chip stocks. And the PEG ratio should be less than 1.5 for the blue chip companies. And there is interest coverage ratio, which should be more than 2. So what is interest coverage ratio? It is the earnings after the interest plus taxes divided by interest expenses. It's called interest coverage ratio, which should be more than 2. So all this criteria has to be present to call it as a blue chip stock. And all the names I mentioned in the 7 sectors that I mentioned, they all qualify, fulfill this criteria. So when you go into fundamentals and look into it, all these criteria will be fulfilled. Then there's something called price per cash flow that should be less than 15/20, and market cap divided by operational cash flow is also something important. So if you look at the price per cash flow, so look at this company one, stock price is 25 and cash flow is 5. So cash flows in a company has to be good. If cash flow is good, it shows the strength of the company. So if you look at company one, stock price is 25, cash flow is less 5. But if you look at company two, your stock price is 25, but cash flow is better. So now which company is better? So now for that, you have to do price per cash flow. If you do price per cash flow, company one, price per cash flow is 5, but the company two is 2.5. So the one with a lower price per cash flow has a better value. Okay, so if you see as an isolated number, you think the cash flow is better here. So any price with the cash flow better is a better company. So P by CF tells you which company is better value. So price per cash flow 2.5 or less has a better value. And there is price per book ratio. If it is less than 1, it tells you that you are getting a stock at a much better price. And I told you about market cap, small cap. We divide the stock portfolios into small cap, mid cap, and large cap. Small cap is where your market cap is 5,000 CR. Mid cap is where your market cap is 25,000 CR. Large cap, all the 7 sectors which I mentioned is market cap of more than 25,000 CR. So, and they qualify as a good stock for long-term investment for 7 years. So these are some of the basic fundamental criteria that at least you should keep in mind. So all this, although it appears like very complicated, when you open any stock in say money control, all those ratios will be soon. You just have to refer and see either P is low, PEG ratio is low, price per cash flow is low, and debt is low. So, and operational cash flow is good. So these are numbers which are shown. If you open money control now, you look into any stock, all these ratios will be seen. You see these ratios and then make some assessment whether the stock is good to go. So there's something called MPDDS criteria, like you have different criteria for scoring the severity of the disease or outcome of the disease. So for intensives, the take home message is you can stick to this MPTDS as to which stock you would pick up for 7 years investment. So what is MP? So even if you forget all that what I've said, PE ratio, PEG ratio, or the debt by cash flow ratio, price per book ratio, stick to this MPTDS criteria. Look at market cap. Market cap for you should be more than 10,000 CR. Any company you pick up for 7 years. And you look at profit. Profit should be in an uptrend for last 10 years. It should not be like it should be up, down, up, down. So the profit of the company should be keep on going up over last 10 years. That tells you that company is very robust. And company should be paying tax. They should not be a tax defaulter. They should be paying tax every year, and the tax they're paying also should keep increasing. Then D stands for dividends. So company should be giving more and more and more dividends every year. And then S is sales. Sales should be increasing, increasing, increasing. It's very simple, MPTDS. Market cap should be more than 10,000. Profit should be increasing. Tax they should be increasing. Dividend should be increasing. Sales should be increasing. All this should be in an uptrend. So if you look at this sort of a more than 10,000 CR, you can go into Google, look for a stock screener. You'll get so many different programs. If you see this, Nestle, look at this, 1,59,560 CR. Coal India, 82,556 crores. So these are all in crores. So these are all the companies which have a market cap of more than 10,000 CR, right? Then you are seeing Hindustan Unilever. So you can see in the last 10 years, you are seeing from 2006 to 2020, the curve is keeping on going up. So there is a profit which is going up for last 10 years. So this is a profit, right? Then Reliance, you are seeing from 2006 to 2020, it is going up. So these are all where profit is continuing to increase over last 10 years. And you have HDFC Bank, where I said I have my portfolio. You see HDFC Bank, there is a dip here, but overall the curve seems to be on an upward trend. And then Hindustan Unilever, you can see the curve is going up over last 10 years. And then TCS, you can see the curve is little static, but then it has been going up over last 10 years. So this tells you that, so we saw market cap of the companies, we saw the profit lines of this company. Then you look at the cash taxes. Taxes, you have to look into the cash flows. You can see the taxes in 2010, 674 CR, but 2021, you can see how much tax, 2,407. So which means the tax being paid by the company, by tax they'll pay more because obviously profits are increasing. So they're all directly related. Then you're looking at dividend. You can see the dividend here, again Hindustan Unilever, HUL, which we call. So dividend paid out in 2010 is 1,528 CR and 2021 is 8,811 CR. So the dividends also are continuously increasing. Then the last one you have to look is MPTDS. We spoke about market cap, spoke about profit, then we spoke about tax, we spoke about dividend, then last is sales. So you can see the sales in profit and loss from 17,738, it has gone up to 47,028. So this is just an example of this. And if you look at all the 7 sectoral companies I saw, they would fulfill all these criteria. That's why they're all the safe bet. You can put the money. If you don't want to put all this mind, you can just ask an expert. They will tell you which are all the stocks that you should put. Like I tell all my trainees which are all the stocks you can choose from. So I think it is easy to try to pick up your long term. Long term stocks are no brainer because they all have a set recipe. You just have to go with the names and you will be okay. So what is the prescription for you at the end of this talk? Apply MPTDS criteria for any stock that you are going to invest for 7 years and go sectoral. It has to be 7 to 10 sectors and limit to 10 stocks is my suggestion because I would have limited to maybe 12 as a long term. But people go up to 20. Even if you go to 20, it has to be multiples in the same sector. So if you pick two pharma company in this sector, two banks in this sector, two FMCG in this sector, like Marico is FMCG, Nestle is an FMCG. All these are good. And or I have picked up Godrej Consumer, like Infosys. If you have Infosys one, another one you take TCS, but it has to be equally distributed. So L&T, so on and so forth. So it has to be sectoral. And this is very important, do systematic investment, which means because doctors are busy, so you should fix a SIP whenever your salary comes, maybe at the 5th of every month. You should decide that every month you are putting, you have allocated funds for all these 7 sectors. So it may be 1,000 rupees or 2,000, whatever the stock price. So keep on doing every month. Now, SIP is not good enough. Along with the SIP, you have to do dip buy, which means market crashes. Like there is a Iran conflict or Israel conflict, market comes down. When you see in red, go and buy it because that is where you build the value for your portfolio. So whenever the crash, suppose you have bought, like Divis Labs. So Divis Labs may have crashed 5%. Then I have to put in more during that time so that I take advantage of that because they will bounce back and that will yield you rich dividends. And as I mentioned, minimum 7 years investment. You cannot take out money after, unless there is an absolute emergency. Otherwise, you should freeze your mind for at least 7 years after having invested in this. Most important, don't invest and forget it. Keep looking into it, because see, sometimes some act of God, some banks like major S Bank, you might have heard, they have gone kaput. And if you are very agnostic and blindfolded and not paying attention to what's happening, you lose all your money. At least you can take off if some major, like oil. So if you put money in some oil industry and there is a major conflict that is happening, so it will suffer. Like I had traded on Indian Oil Corporation in F&O, and at the time I had taken a trade in F&O. I'm talking about F&O. Then the conflict started with the Lebanon. Iran sent the missiles to Saudi Arabia. I mean, not Saudi Arabia, to Israel. And IOC crashed 5%. I lost a lot of money in that trade when I traded Indian oil. So there are market forces which will have a tremendous influence. Although I had hedged, I had done hedging for IOC, but still I lost some money. So these are some of the things that you need to keep in mind. And so keep a 3D approach. You have to diversify. So I said 7 years. So you have to have your money in mutual funds. You need to have money in long-term stocks always. Those two are the most important. Once you gain more experience, try short-term. Once you get more and more experience, you are able to risk. Maybe if you are playing 100 rupees, 25 rupees, you can play in futures and options for trading, because that is a very high risk game. And always do systematic investment plan and buy during dips. And remember, minimum 7 years. So that's about it, folks. So thank you. Thank you, one and all. So, and we can take Q&A the panel.